Hello, very good morning to all, and welcome back to today's Daily Dose of Market Insights, and welcome back to a brand new trading week. Very good morning. I'm Kelvin here. Today will be the 7th of July, 2025, Monday. So as usual, let's have a quick look at the disclaimer slides first before we kickstart our gist of today's Daily Dose. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exit deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, or projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, let's have a quick recap what has taken shape on Friday over the weekend and as well as in early today's Asia session in terms of that intraday movement on the various broad-based cross-asset classes impacted by the relevant and respective news flow or economic data releases over the last three sessions. So we know that on last Friday, the US cash stock market is actually closed for the 4th of July, Independence Day, public holiday. So not much of a movement, I would say. So what I want to share with you is what has taken shape over the weekend. It's more primarily focusing on the up and coming 9th of July, which is this Wednesday, expiration date of that 90-day pause of US global higher reciprocal tariffs against major or global US trading partners, with the exception of China, which is they actually renegotiated 1.5 months ago to actually drag it down the road. Okay, it's beyond 9th of July. So let us now focus on what has taken shape over the weekend over here. So over the weekend, what we could see over here is that there's a lot of news flow pertaining to this Trump global higher reciprocal tariffs that will set to be expiring. We have the 90-day pause where this higher reciprocal tariff introduced in early April this year. Then Trump initially has this 90-day pause. Then this 90-day pause is set to expire on the 7th of July. And so far, we're only able to have some trade deal, so-called preliminary trade deal done between only three countries: Vietnam, then we have the UK, and as well as we have a so-called trade truce between US and China, but that's not really a official trade deal yet. So over the weekend, Lunit, which is the Commerce Secretary of US, stating that the Trump tariffs will take effect on 1st of August. So that actually implies that potentially Trump may actually give a bit of extension to that 9th of July deadline over here, right? So he's saying that signaling some breathing room for the US trading partners ahead of the 9th of July deadline previously set by the president over here. So with this kind of we call it uncertainty surrounding this pivotal week pertaining to the implementation of this higher reciprocal US trade tariffs, especially we know that currently there is not so rosy discussion between US and Japan, where last week Trump threatened to actually slap Japanese exports heading to US by higher tariffs of 30 to 35%. And so far there is no headline or headway being made between US and EU. But however, Trump floated that the negotiation between India and US is pretty promising, and South Korea and Taiwan, and you have even Thailand over here. Things are still a bit sketchy at this moment in time. So with this kind of uncertainty and very kind of a volatile situation where things could be impacted by a sudden news flow coming out from the US White House administration, that could potentially shock the market, at least on the intraday basis. We start to see profit taking coming in the E-mini futures as we are speaking right now. So the S&P E-mini futures is actually down by negative 0.4% as we are speaking, and the Nasdaq E-mini futures is down by almost the same magnitude at negative 0.45%. And over at Asia right now, we start to see also profit taking, or I would say that it's rather a lackluster intraday performance among the Asia Pacific major benchmark stock indices, where the Nikkei 225 is shading negative 0.46%. The Hang Seng also down by a similar magnitude, down negative 0.45%. The higher beta Hang Seng Tech Index, which comprises of the China big tech stocks, down by a smaller magnitude of negative 0.2%. And over to Southeast Asia, in Singapore is actually one of the star performer today, up by 0.25%. And you go down to the further down will be Australia. ASX 200 is down by negative 0.2%. So Singapore is more pertaining to its defensive play, especially on the REITs components that is holding up the STI right now, which is up by 0.23%. And also over the weekend, we have this OPEC news release over here, where OPEC decided to actually further hike up its oil supply in the Middle East region starting from August this year. So while we are speaking right now, if you look at the oil price, it's actually down. It actually get down initially. So oil price over here, yeah, it's down by almost negative 0.9%, right, as we are speaking. Okay, so this is the oil price. It should actually show the chart of the oil over here. There's actually a sell-off at the start of today's Asia session. All right, so what's the reason leading to this intraday weakness in oil price is due to OPEC cut a high, high industrial, high oil supply more than expected over here. Okay, so let me share with you the chart. Yeah, this is the one, right? So OPEC plus supply increases rises glut concerns. That means potentially some form of more supply than demand globally for the oil market. So OPEC agreed over the weekend to increase oil production by 548k barrels per day. That's 548k barrels per day, starting from next month in August. So that's actually exceeding expectation and sparking concerns about over supply. So over here, do not forget over here that previously we start to see initially OPEC. Initially, there was actually a spike up to almost $70 per barrel. Then thereafter, due to this concern about oil supply disruption in the Straits of Hormuz, due to that onset of the Israel-Iran conflict, and thereafter the conflict got subsided and oil prices plummeted back down towards the 67 level. So apparently, it seems to us that OPEC Plus wanted to have an oil price that doesn't exceed $70 per barrel. All right, so it seems to us that over here is that despite this ongoing potential negative global growth impact coming up from the US White House administration trade tariffs policy, that could actually slow down the demand of oil globally, but that's not their concern. For OPEC Plus, OPEC Plus is in the mode of increasing oil supply, despite the fact that there could be potential less demand shocking out from this more abundant supply in the oil market. So that actually explains the lackluster price movement in the oil market right now as we are speaking over here. So previously, OPEC Plus announced 411k barrels of oil increase for the month of May, June, and July, and market expectation is only market is actually expecting last weekend, which is 2 days ago, to maintain the same momentum of oil supply increase at 411k per barrel per day, 11k barrel per day. But instead, OPEC Plus decide to go against the previous month of supply increase by hiking up to much more wider than expected at 548k. So that should explain the ongoing weakness in oil price right now, where last Friday we flipped back to a bearish bias using that 670k per barrel as a key resistance level, which is so coincide with the key 200-day moving average, where it integrate back below it 1.5 weeks ago for West Texas oil. And over at the FX market, if you still recall that late last week, we have a so-called bias of a potential multi-day mean reversion rebound in the US dollar Okay, that means i.e. Talking about that 3 weeks plus of dollar decline has really reached a certain overextended inflation zone, where potentially there could be a snapback rally in the US dollar, and that snapback rally indeed takes shape as we are speaking right now. So what we could see over here is that the dollar is actually strengthening against the Aussie and in line against the Kiwi, and also strengthening against the sterling dollar, which is up by 0.76%, but not so much against the Swiss, the euro, and as well as the dollar CAD, which is the dollar is only up marginally by positive 0.19%, up against the euro positive 0.13%, and up against the dollar CAD by 0.12%. So this is a 5-day rolling performance of the US dollar against the other major currency as of right now we are speaking. So if we look at the 1-day rolling performance, that means more taking into account of today's Asia session. So at the start of today's Asia session, we see a short bounce up with the in line with the dollar Aussie and the dollar Kiwi. So that also came within our expectation, where we expect the dollar, the Aussie dollar, to face some headwind at the 66 psychological short-term pivotal resistance, where we expect that pullback to actually take shape back down below that so-called 0.6530, 0.6510 level. So later I'll touch on more about the intraday technical outlook on the Aussie dollar, given the fact that the support level that we mentioned in our previous bearish bias over late last week, I mean late Thursday and Friday, has more or less made its so-called support levels. All right, so that pretty sum up the first segment of today's daily dose of market insight. So let us now move on to the second segment, okay, which is the intraday technical outlook on those broad-based cross asset classes that we cover on a daily basis, starting with the FX market first. So before that, let me expand my screen. All right, so let's start with the euro dollar. All right, so the euro dollar last Friday, we do have a bearish bias holding below that 118.10, 118.25 level. The hourly RSI continues to be kept by this parallel descending a trend line, and also now it inches back down below the 50 level mark, hasn't hit the oversold level yet, so indicating there could be still some form of bearish momentum that is supporting this bearish bias that we have from last Friday. So still no change, still using the 118.10, 118.25 as my short-term pivotal resistance level on the euro dollar. Maintain our bearish bias for this ongoing minor corrective decline pullback, or minor corrective mean reversion decline within a larger time frame bullish trend that is still intact on the euro dollar, because the euro dollar medium-term bullish trend is still intact, as price action managed to hold above the 20 and the 50-day moving average so far. So support level to watch on the intraday basis, there'll be two. One is a 117.45. Breakdown below it may expose the minor swing low area of 27th of June, and as well as 27th of June at 116.85. And if you do the FIBO extension of this entire prior impulsive uplift from the minor low of 23rd of June all the way up to the minor high of 1st of July, that coincide with 38.2% FIBO retracement as well. All right. However, if price action starts to shape a bullish U-turn and a bullish breakout and an hourly close above 18.25, 118.25, that will invalidate that bearish bias for that mean reversion decline scenario to be invalidated, and continue it and potentially see the continuation of this impulsive upmove sequence, exposing the next near-term resistance at 118.70, followed by 119.10 next. So 118.70 is a FIBO extension cluster level, and so coincide with the upper limit of this medium-term ascending channel that is still in place since 13th of May 2025 low over here. So that's for the euro dollar, still maintaining our bearish bias below 18.25 for that potential minor mean reversion decline to play out. Next up will be the sterling dollar over here. So the sterling dollar continues to be rather lackluster, can't break above our pivotal resistance that we highlighted on Thursday. Since Thursday, I would say 136.70, 136.90. So we will still maintain our intraday trend bearish bias for sure, because given the fact that the hourly RSI continues to be kept by this bearish descending trend line resistance. All right, so first support level to watch will be at 135.70, where it managed to survive on last Wednesday, due to that onslaught of that internal political fiasco, where there could be a risk that the current finance minister potentially that could be replaced by someone that is much more less hawkish on physical discipline. So that doesn't in short term doesn't gel well for the sterling dollar. So but technically it continues to show no clear signs of upside momentum recovery. So with that we still maintain our bearish bias. So below 135.70 exposes the 50-day moving average. We also coincide with the minor congestion area of 20th of June at 134.70. And if you do the Fibo retracement of that prior impulsive uplift from the minor low of 23rd of June all the way up to the minor high of 1st of July, that also potentially coincide with the 76.4% Fibo retracement. Only a bullish U-turn and an hourly close above 116.90 that would invalidate our minor mean reversion decline scenario to kickstart another round of impulsive up move for a potential bullish so-called potential continuation of the boost, seeking out the next intermediate resistance zone at 138 figure slash 138.30. Above it exposes 138.70 next. So that's for the sterling dollar. Next up will be the Asia Pacific currency against the dollar with the Aussie dollar on site. So the Aussie dollar, recall that we have a bearish bias. So this bearish bias already hit our pivotal, hit our support level that we mentioned on last Friday, 65.30 and 65.10. We also coincide with this 20-day moving average and as well as the pullback support line of that former 8-week resistance that previously kept it in a very sideways range from that so-called late 23rd of April all the way up to 26th of June before we see a bullish breakout on the late June as well, in the 4th week of June. All right, then thereafter right now is retest this level again and revisit the 20-day moving average at 65.10. So given that I do not want to use the 65.10 as my short-term pivotal support just in case of any the noises due to the news flow, and as well as don't forget before today this week after today, this week we will have another key RBA interest rate decision. So later I'll touch on more about the economic calendar on things to look out for. So that could create a bit of volatile movement for the Aussie dollar even in today and stretching into early tomorrow Asia session. So with that, I will use a slightly lower level, which is 64.80 as my pivotal support level, and this pivotal support level short term will be also coincide with the rising 50-day moving average, the minor swing low area of 24th of June, 26th of June, and if you do the Fibo retracement of this minor impulsive up move, bullish minor impulsive up move from 23rd of June minor low all the way up to the minor swing high of 1st of July, that coincide with the 50% Fibo retracement. Right, so there is seems to us that there is more technical level that the technical elements that technical elements that indicate that 64.80 is a more important inflection level compared to 65.10. So hence I will use 64.80 as my short-term pivotal support level, flipping back to a bullish bias for a recovery on the Aussie dollar, given that the bearish bias support level has really been made, which we highlighted late last week at 65.30, 65.10. First resistance level to watch will be today's intraday session high at the start of the Asia session, which is 65.65. So let me put it in writing. 0.6565. All right. Above 6565, potentially revisit the 11th of November 2024 swing high area and also coincide with the psychological level of 66 figure. However, if price action continues to tumble downwards and have an hourly close and a bearish breakdown below 64.80, then this potential minor decline sequence is likely to get extended further to the downside, exposing the key 200-day moving average that also coincide with the minor congestion area, as you could see on my hourly chart over here, from 23rd of June to 24th of June at 64.20. All right, so using 64.80 coincide with the rising 50-day moving average, we'll be flipping to a intraday bullish bias for the Aussie dollar for today. Lastly will be the dollar yen. So the dollar yen continues to trade within our neutrality range over here. So still no change, still no conviction of any directional bias at this point in time. So maintain our neutrality stance as of last Friday, holding between 145.20, our upper neutrality limit, and the lower neutrality limit will be at 144.15 for sure. Given that in today's Asia session at 9 a.m. Singapore time, they attempt to have a retest close to it before shipping this bounce at the 10 a.m. mark. So neutral between 145.20 and 144.15 for now between $40 yen. Excuse me. So next up will be the major stock indices, starting with the Hong Kong 33, representing the Hang Seng Index. So the Hang Seng Index continues to have this kind of lackluster movement, but managed to hold above our first support level that we highlighted on last Friday at 23,690/560, and we have a pivotal short-term pivotal support at 23,330, which coincide with the lower limit of this ongoing minor ascending channel from the low of 2nd of June, and also coinciding with the rising 50-day moving average as well. So still no change given that price action can break above our first resistance level that we highlighted on Friday, which is 23,880, where it tested it during the 11 a.m. hour mark during the last Friday Asia session. Then thereafter it just thundered downwards, and there is actually a slight minor gap down in today's opening Asia session as well, and price action now attempt to actually shape a bounce of it after we start to see this hourly bullish hammer candlestick at the 9 a.m. mark. All right, Singapore time. So with that, still using that 23,330 level as my short-term pivotal support, still maintain that intraday bullish bias, but price action got to have a quick break up above 23,880 in order for the recovery to gain more credence to seek out the next intermediate resistance level on the intraday basis, which is the minor swing high area of 2nd of July and 27th of June at 24,270. Pardon me. However, if price action starts to have a bearish push down and breakdown and hourly close below 23,330, this bullish bias recovery scenario will be invalidated to see the continuation of the corrective decline sequence, exposing the minor swing low area of 20th of June at 23,060 next. So that's for the sterling, that's for the Hong Kong 33, pardon me. All right, next up will be the Nikkei 225 or the Japan 225. So the Japan 225 also continues to actually trade downwards over here, but still managed to hold above our pivotal support level at 39,390. All right, what you could see over here. So with that, we continues to actually have that bullish recovery scenario, still using that 39,390. But however, we have now have a tighter short-term pivotal, tighter first resistance level to watch, or upside trigger level at 39,915 over here. So that's for the Japan 225, representing the Nikkei 225. All right, over here. So let me put this in writing. 39,915. Okay, so above 39,915, then potentially we could see the recovery gaining more credence towards the next intermediate resistance level at 40,355. However, if price action plummet downwards and have an hourly close below 39,390, then for sure this minor corrective decline sequence that from this 30th of June 2025 minor swing high continues to extend further to the downside, exposing the next support level to watch will be at 39,145, followed by 38,850, which is coincide with the 20-day moving average as well between these two next intermediate support level. And also 38,850 is also the critical important pullback support of that former medium term ascending triangle range configuration, formerly in place since 13th of May. Then thereafter, it has a bullish breakout on 25th of June, now turns into a critical pullback support at 38,850. Right, so that's for the Japan 225. Next up will be the Germany 30. So the Germany 30 continues to trade sideways above our pivotal support level at 23,770, where we highlighted it on last Friday. And what we could see is that price action now attempting to bounce off it as we're speaking right now. So for sure, this level will still be my pivotal support level to watch for today, as it continues to be held above the 20-day moving average. All right. So with that, still maintain our intraday trend bullish bias on the Germany 30 using 23,770 as my short-term pivotal support level. First resistance to watch will be last Thursday intraday high at 23,950 level. 23,950 level. Above 23,950 level exposes the next intermediate resistance level will be at 24,110. However, a price action plummeted downwards and the hourly close below 23,770. Today's intraday bullish bias will be invalidated to see another round of choppy corrective decline sequence unfolding, exposing the next near-term support level at 23,570, followed by 23,440. That's also coincide with several key Fibo retracement levels, which is at 50% Fibo retracement and the golden ratio of 61.8% Fibo retracement, taking into account of that previous impulsive up move on a minor time scale from 19th of June 2025 low all the way up to 30th of June 2025 high. Right, so that's for the Germany 30. Watching closely the 23,770 as my short-term pivotal support to maintain that intraday bullish bias. Next up will be the major US stock indices, starting with the US Wall Street 30. So the US Wall Street 30 on last Friday during the so-called futures market that is still open. But however, price action starts to do that pullback, and today's Asia session it bounces. So overall, still no change in terms of the technical configuration. Still continues to actually evolve in this impulsive upmove sequence since the low of 19th of June. So I'll be using the same pivotal support level that we have on Thursday or on Friday at 44,400 level. So using 44,400 level, maintain my intraday bullish bias on the US Wall Street 30. First resistance level to watch will be the all-time high area at 45,100. We also coincide with a Fibo extension level as well at around the 1.236 and the 1.618, depending on I would say on different minor swing low. All right. Above 45,100 exposes the next resistance level at 45,455/45,520, which is also a Fibo extension cluster levels. Only a bearish breakdown and hourly close below 44,400 that would invalidate today's intraday bullish bias on the US Wall Street 30 to kickstart another round of minor corrective decline sequence, exposing the next support level at 44,670/43,965. Only a breakdown below 43,965 may see a deeper minor corrective decline sequence unfolding towards 43,600. We also coincide with the lower limit of this minor ascending channel taken from the low of 19th of June. So that's for the US Wall Street 30. Next up will be the S&P 500. So the S&P 500 also continues to trade in a rather lackluster fashion on last Friday. And today's Asia session, it tend to actually bounce over here. It gap up, and right now it covers the gap and just traded in a very small doji-like hourly candle in the last 3 hours. So no change. Still looking at the 66,220 as my short-term pivotal support level. So as long as this level didn't surpass on the downside, we will still maintain our intraday trend bullish bias on the SPX 500 for the S&P 500. Next resistance level to watch will be last Thursday resistance level that it met at 6,290. Above 6,290 exposes the next level at 6,330/6,355, which is another fresh all-time high. Okay, based on the 1.236 Fibo extension. However, if price action starts to actually break down and the hourly close below 6,220, today's intraday bullish bias will be invalidated to kickstart a minor corrective decline sequence, exposing 6,180, a breakdown below 6,180, which is so the pullback support of that former minor ascending wedge resistance that I previously drew from the high of 29th of May. then that could trigger off a deeper minor corrective pullback towards 6,136/6,110, which is so confluencing with the rising 20-day moving average. Okay, so that's for the SPX 500. Next up will be the Nasdaq 100. So the Nasdaq 100 continues to involve in this bullish impulsive up move sequence, a minor one from the low of 23rd of June, holding above the minor ascending channel support as well at 22,710. So no change, using 22,600 as my short-term pivotal support level, and the hourly RSI continues to be supported by this parallel ascending trend line as well. You can see over here, drawn from the low of 1st of July. So no change, using 22,600 as my short-term pivotal support, maintaining our intraday bullish bias on the Nasdaq 100. First resistance level to watch will be on last Thursday minor swing high at 22,920. A break above 22,920, potentially scout the next fresh all-time high at 23,190, which is so confluenced with a Fibo extension clustering level, and as well very close to the upper limit of this minor ascending channel. Only a bearish breakdown below 22,600 will invalidate the bullish movement to kickstart a minor corrective decline sequence, exposing 22,360. Below it may see 22,235/22,065, which coincide with the rising 20-day moving average. All right, so that sum up the intraday technical outlook on all the major stock indices. Next up will be the commodities market, starting with gold XAU/USD. So gold XAU/USD broke down below the 50-day moving average, which is at 3,318, but however managed to find some support level as we're speaking right now, right at the medium-term ascending trend line that we drew from the low of 31st of December, and the hourly RSI already hit the oversold region and now attempting to stage a bounce from the oversold region. So with that, technical elements are mixed at this moment. So I prefer to turn neutral right now between 3,293 and 3,360, which is the upper limit that is which is the minor resistance level that previously in place since 1st of July, tested 3 times and can't break in the last Thursday before it traded downwards over here. So however, if we start to see a hourly breakdown below 32.93, then potentially this movement of the gold XAU/USD will transform into a much more deeper minor corrective decline sequence, exposing the 30th of June swing low area at 3,250. Below it sees 3,005 next, which is the minor swing low of 19th of May and 20th of May. So given this mixed element right now, I'm not so convinced of any directional bias, so decided to turn neutral for gold, at least from a short-term perspective, in today's intraday session between 3,360 and 3,293. Next up will be the West Texas crude oil. So West Texas crude oil, last Friday, we have the pivotal resistance zone at 69.15, pardon me, /70.60. So still no change, still using this as my pivotal resistance zone on an intraday basis for today, 69.15, 70.60. Still maintain our bearish bias. Support level to watch will be at 64.05, which is the 50-day moving average support as well. A breakdown below 64.05 potentially may see further weakness towards 62.50. Only a bullish breakout above 70.60 will see the start of another corrective rebound sequence coming into play, exposing the next resistance level at 73.60 for West Texas oil, which is also a Fibo retracement level taken from the last sell-off from the high of 20th of June all the way down to the low of 24th of June. That coincides with the golden ratio as well at 61.8%, which is very closely at the 73.60 level graphical resistance. All right, so that's sum up the intraday technical outlook on all the major cross asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to take note of for today's session? So for today's session, as we head into the European session, which is on Monday, 7th of July. We will have the Germany industrial production numbers for the month of May out at 2 p.m. Singapore time. So the market is expecting a slight recovery. Previously, it has a month-on-month negative reading of negative 1.4%. This month, the negative gap is expected to cover up to be no growth at 0%. And if it starts to go beyond 0%, that could potentially indicate that the manufacturing sector in Germany starts to recover, and that could have a potential impact on the Germany 30 and the euro dollar and the euro crosses as well. Then what we could have is that on 5 p.m. we have the aggregated Eurozone retail sales month-on-month figure, which is markets expecting is coming in at negative 0.7%. Okay, which is a weak reading compared to previous month of 0.1%, and even the retail sales figure on the year-on-year basis, market also expect a slowdown to 1.2% versus 2.3% in April. All right, then thereafter during the European session, and will be very quiet, and even the US session, there is not much data to look at except for the news flow that is pertaining to the up and coming 9th of July expiration of the 90-day pause on the global US higher reciprocal tariffs. And during the start of tomorrow Asia session, we have 9:30 a.m. We have the Australia Business Confidence Index compiled by NAB up at 9:30 a.m. That could potentially impact the Aussie dollar and the Aussie crosses, and as well as the ASX 200. And most importantly, will be at 12:30 p.m. That will be Australia RBA interest rate decision, where market has really priced in a potential 25 basis point cut from 3.85%. All right, so given the fact that RBA is also one of the much more less dovish bank that is pretty much late in its interest rate cut cycle. All right, something to take note of. So with that, that sum up today's daily dose of market insights. I'm Kelvin here, wishing you all a great day ahead, and we should speak again tomorrow. Thank you.